करो। Hello, good evening friends. Please come to Ind AS 32. Ind AS 32 is financial instrument presentation, and as you know, this is one of the most important standards in our syllabus. If you understand this standard, then you will be able to understand other standards like Ind AS 109. Plus there is a reference of this standard in other standards also like Ind AS 12, etc. So we are going to quickly go through all the important provisions of Ind AS 32. So are you ready? So what is the basically requirement of Ind AS 32? The requirement of Ind AS 32 is, it first deals with classification of financial instrument into financial asset, financial liability and equity instrument. So whether an instrument will be financial liability, financial asset or equity. That is one of the major tasks in this standard, and that is what we will learn as we'll go ahead. Then the next is, can financial asset and financial liability be offset for presentation purpose in the balance sheet? So can, for example, debtor and creditor be shown net of each other in the balance sheet? So that is the question we'll discuss. And then this standard also deals with the treatment of interest, dividend, gain, losses, interest, dividend, gains and losses in the financial statement. So our objective is whether a financial instrument is financial asset, financial liability or equity, whether financial asset and financial liability can be set off against each other for presentation purpose, and third is, what will be the treatment of interest and dividend, gains and losses in the profit and loss account and SOCIE. So let us first deal with the definition of financial instrument. What is a financial instrument? What is a financial instrument? A financial instrument is a contract. So first feature of financial instrument is it should be a contract. The contract should give rise to financial asset for one enterprise, and it should give rise to financial liability or equity instrument of another entity. For one entity it is financial asset, for other entity it should be either financial liability or equity. If this condition is satisfied, then this is a financial instrument. So what is the important feature of financial instrument? It is important that there must be a contract. There must be a contract. So income tax liability is not a financial instrument because there is no contract. It is a statutory liability. It is a statutory liability. Income tax liability payable is not a financial instrument. In a financial instrument, there are two parties involved. Who is the first party? The first party is the issuer of the instrument. The first party is the issuer of the instrument. The entity which has issued the financial instrument, either it will present it in the balance sheet as liability or equity. The issuer will show financial instrument as financial liability or equity, and the second party is called the holder of the instrument. The holder of the instrument will call it as a financial asset in the balance sheet. So I'll give you some example to understand financial asset and financial liability or equity. For example, one party will show debtor, the other party will show creditor. one party will show cash, the other party will show, or it is a liability of RBI. So cash is a financial asset for one party and it is a liability for RBI. Then investment in equity share. Suppose one entity has invested, it is a financial asset. For the other entity, the one who has issued the equity share, it will form part of equity. Then investment in redeemable preference share is financial asset for one party. Issue of redeemable preference share capital is a financial liability or equity for the other party. Bank balance is financial asset in our book and it is a financial liability in the books of the bank. Now there are some contracts which are receivable or payable, but these are not financial instrument as per Ind AS 32. So they may be receivable or payable, but these are not financial asset or financial liability as per Ind AS 32 or Ind AS 109. So this is a list of exception, that is, on these items Ind AS 32 will not apply. What are these items? One is indemnification asset, that is amount recoverable from another party in case of loss. Ind AS 37 is applicable. Rights and obligation under employee agreement, Ind AS 19 is applicable. Share based award, Ind AS 102 is applicable. Investment in subsidiary, associate, joint venture. If the entity selects the option to record on underlying cost basis, investment in subsidiary, associate, joint venture can be recorded either on cost basis or fair value basis. If they are recorded on cost basis, this standard is not applicable. Then agreement made for business combination are out of the scope. Deferred consideration is covered within the scope of this standard. Deferred consideration means consideration payable at a later date will be covered. Insurance contract, Ind AS 104. Contract assets and liabilities covered by Ind AS 115. So Ind AS 115 also we had covered in our discussion. Then lease receivable and lease payable at the inception of the lease will be covered by Ind AS 116. So accounting of leases initially will be covered by Ind AS 116. What about subsequent treatment? Subsequent treatment will be covered by this standard. For example, impairment of lease will be covered by Ind AS 109. Certain loans and financial guarantee contracts will be covered by Ind AS 104. And certain executory contracts, not all executory contracts, some executory contracts are outside the scope of this financial instrument standard, and some executory contracts are within the scope of financial instrument standard. So there will be a question on this part in the exam, that whether this executory contract will form part of financial instrument standard. So for that I am going to tell you some important hints. Likely question from executory contract. Executory contract means contract to buy or sell any non-financial item which is needed for the usage requirement of the entity. For example, a company which requires cement may enter into a future contract, forward contract to buy cement. Company which are suppose printing books, they may enter into a future or forward contract to purchase paper. So these are executory contract. A contract entered today which will be executed in future, whether this will be covered within the scope of this standard or not. Please reply whether this will be covered by the standard or not. So here my answer is, first we'll apply what is called past practice test. Like, I am a teacher, I have nothing to do with paper or steel or cement. I have the practice of entering into such contract in net cash settlement. That means I only receive or pay the difference. I am really not interested in steel, paper, cement, milk, copper. Okay. If the entity has past practice for quick buying and reselling of non-financial item, the other possibility is I buy and sell immediately. There is no time gap or no major time gap between buying and selling such non-financial item. My objective is to make a quick profit. My objective is to make a quick profit due to price changes. So I buy it and I sell it and I corner the price differences. Then what we will do in such cases, past practice test has been satisfied. So one, I have the history of net settlement. Second, I have the past practice of buying and selling it immediately to make quick profit. Past practice test has been satisfied and I will account for such executory contract under financial instrument standard, because I am really not interested in the underlying non-financial asset. I am not interested in paper, I am not interested in cement, I am not interested in steel. I am interested in making quick profit. So they will be treated under this standard. Second test is whether contract permits net settlement. Does contract allow you to make net settlement and the entity intends to settle the contract on the net basis? Whether the entity wants to settle the contract on the net basis. If the answer is yes, the contract allows net settlement and the entity intends to settle on net basis, then also condition of Ind AS 109 is satisfied and the standard will be applicable. Other executory contract are outside the scope of Ind AS 109. Then what will be the treatment of such executory contract which come under the scope of Ind AS 109 or Ind AS 32? This kind of contract will be treated as a derivative contract, a derivative asset or a derivative liability, which means they will be treated like a forward, future or option contract. Point number E, entity has an option to designate its contract within the scope of Ind AS 109. So one more situation when you can apply 109, when there is a choice to settle on net basis. When there is a choice to settle on net basis and the entity has an option, the entity is given a choice, it can designate the contract as within the scope of 109. So what is the difference between this point and this point? Both look similar. In this point, the top point, the entity intends to settle on net basis. In the last point, the entity has an option to designate it as a derivative contract if it has the option of net settlement. Now we'll come to the meaning of financial liability. The students are wondering where we will get the notes. So dear student, these notes are from this book which is called Financial Reporting Compact Book. We have prepared this wonderful compact book which contains the entire theory in very simple words. You can easily understand. Institute material is full of complicated language, jargons, difficult sentences. We have bifurcated that into simple sentences in small paragraph. Plus I have also given journal entries that is required to be passed whenever you have a question of journal entry, all Ind AS are covered in this booklet. Very useful for last minute revision. You can get it on our website vinod.in. In addition to that, there is a summary chart also. If you want to revise your entire syllabus in say 2 to 3 hours, one day before the exam, you can purchase this summary chart book from our website vinod.in. Very useful for last minute revision in simple language, chart format. This book is available. Thank you. And now let us come back to the meaning of financial liability. This is one of the little complicated part of the standard, but trust me, if you pay attention, you'll be able to understand. A financial liability is a liability which qualifies any of the following 4 elements. Any of the following 4 elements. Again, a highly tested area in the exam. They will give you a situation and the student has to answer whether this situation is a financial liability or not. So you have to check for whether any of the following 4 elements are present. We will call it element. So first element number 1, financial liability is a liability which is having a contractual obligation. So first see whether there is a contract. Income tax liability is not a financial liability because there is no contract. It is a statutory liability. The contractual liability should be to deliver cash or any other financial asset. The contractual liability should be to deliver cash or other financial asset. For example, bank, financial asset example, bank, bills receivable, investment, etc. If there is a contractual obligation to provide goods, or service, then it will not be a financial liability. For example, warranty. In warranty, we have a contractual obligation to repair or replace. So that will not be a financial liability. So simple test is, the contractual obligation cannot be avoided. The entity will be required to make payment in cash or other financial asset, and it can't be avoided. Then the element number 1 is satisfied. Contractual obligation to deliver cash or other financial asset. Some examples of element number 1 financial liability is loan, debenture, trade payable, bills payable, expense payable. These are financial liabilities. Your stipend payable is also financial liability. Okay, now we'll come to element number 2. Now as we'll go ahead, the definition will become little complicated. Element number 2 says a financial liability is a liability which has a contractual obligation. So this is common, to exchange financial asset or financial liability in potentially unfavorable condition. In potentially unfavorable condition. So these are basically derivatives which have become unfavorable. Unfavorable means when you will settle it, it will result into loss for you. So potentially unfavorable condition. These are derivative liabilities which may be positioned in unfavorable condition in future and will be required to pay in cash, bank, investment or equity. So suppose for example, you have entered into a future contract to buy share at 100 rupees. You have entered into a future contract to buy share at 100 rupees, but the future rate is now 90 rupees. It has gone down. So this future contract will become unfavorable because you have to buy one share for 100 rupees whose value has gone down to 90 rupees. So contract becomes unfavorable to you. Now element number 3. Element number 3 is, as we'll go ahead, a little more complication will arise. A financial liability is a liability which is a contractual obligation which is a non-derivative in nature. Non-derivative in nature. Contract is non-derivative. Remember, the second one was derivative which is unfavorable. Third is a non-derivative contract which will be settled in own equity instrument. Non-derivative contract settled in own equity instrument which will be variable in nature. That means the number of equity share to be issued will be variable. For example, I have to pay a loan 10,000 rupees. I have to pay a loan of 10,000 rupees and I will settle the loan based on market price of the equity share. Number of equity share to be issued will depend on market price of the share. Number of equity share to be issued will depend on market price of the share. Now tell me how many equity share will be issued. If the market price of the share is 100 rupees, then 100 shares will be issued. If the market price of the share is 200 rupees, then 50 shares will be issued. The market price of the share is 1000 rupees, only 10 shares will be issued. So in that case, we will call it a financial liability. So the summary of this is non-derivative contract where the settlement will be based on own equity instrument and the number of equity instrument to be used will vary. Then in that case it will be a financial liability. And element number 4, whenever any contract which is derivative in nature. So element number 2 was also derivative, element number 4 is also derivative, but element number 2 was financial instrument which has become unfavorable. Element number 4 is derivative instrument settled in own equity instrument, like for example a future contract or an option contract which will be settled in own equity instrument, it will be recorded as a financial liability. So a derivative contract like option future which will be settled in the form of own equity instrument will be treated as a financial liability except in case of those derivatives which will be exchanged for fixed cash against fixed number of own equity instrument. Very, very important. So a derivative contract which will be settled in own equity instrument where a fixed amount of cash will be exchanged against fixed number of shares, then this will be equity instrument. But there is a fixed amount of cash and variable number of equity share, or variable number of or fixed number of share against a variable amount of cash, then that will be treated as a financial liability. So what is the exception over here? A derivative contract which will be settled in own equity instrument and it will be settled against a fixed amount in cash and a fixed number of equity share will be treated as equity instrument. So when all conditions are satisfied, we will call it as financial. Will any of the 4 conditions are satisfied, we will call it as financial liability. Now the student is asking, what is a derivative contract? The student is asking, what is a derivative contract? So derivative contract means when following conditions are satisfied as per this standard, then that contract will be treated as derivative. So first is, derivative means contract whose value will change as the value of the underlying will change. For example, index future, as the index value will change, the value of future will change. Gold future, as the value of gold will change, the value of that contract will change. Call option on Infosys share, as the Infosys share price will change, the value of call option will also change. Second condition is it requires no investment. For example, forward contract may not require any investment or may require a very low investment, like option contract. You have to pay a premium amount which may be some percentage of the total value, or in future contract you may have to deposit some margin money. As compared to the value of the contract, the amount to be paid is very low. And the third feature of a derivative is that it will be settled at a future date. A derivative contract is settled at a future date. So when all the three conditions are satisfied, then it is a derivative contract as per the standard on financial instrument. So I'll repeat, its value will change due to change in the value of underlying. It will be settled at a future date. It requires either zero investment or very low investment. Example of derivative, your SFM syllabus, options, call, put, future, that is which are traded on exchange, forward contracts which are over the counter derivative, and swap contract which are, example, interest rate swap, commodity swap. Sir, what are these items? This you will study in your SFM syllabus. Okay. So dear student, we teach two subjects for CA final, SFM and FR, and I have recorded the lectures in English and full Hindi. So if you want to purchase this comprehensive lecture on FR and SFM, you can purchase from our website vino.in. This is our website, and you will be able to easily find out FR SFM by CA Vinod Kumar Agarwal. I highly recommend, because we have taken lot of efforts to prepare this lecture, record this lecture, and you can either purchase regular lecture which will cover full syllabus in detail, or you can purchase revision lectures which will be like theory will be fully covered, but the number of problems will be limited. So FR SFM regular and revision video lectures are available in English and Hindi. Probably we are the only academy, we are providing in both the languages regular lecture also and revision lecture also at a very low price, so that maximum number of students can get the benefit. Now the next question is, when should financial liability be recognized? When should financial liability be recognized? When should be the liability be brought into the books of account for the first time? So the answer is, financial liability will be recognized when the entity becomes party to it. When the entity becomes party to it means when the contractual obligation can be enforced by the law. So when the entity becomes party to a contract, then in that case financial liability is recorded in the books of account. Now another question is, what are the types of financial liability as per this Ind AS 32? So financial liabilities are two types only. Financial liabilities are only of two types, FVTPL and amortized cost. FVTPL means fair value through profit and loss account. So at the inception, at the beginning, when you are recognizing financial liability, you have to decide whether it will be FVTPL or amortized cost. Falling financial liabilities will always be treated as FVTPL. So check this one. If it fits into the following financial liability, it will always be FVTPL. And if it is not FVTPL, then it will be amortized cost. So which are the financial liability which will always be treated as FVTPL? Derivative liabilities. Derivative liabilities will be treated as FVTPL. Financial guarantees and loan guarantee contract. Financial guarantee and loan guarantee contract will be FVTPL. Contingent consideration. Contingent consideration means consideration payable on future event. You will study in Ind AS 103 contingent consideration. This will be always treated as financial liability. And fourth is accounting mismatch. This I will discuss at the end of this chapter, so you keep watching this video till the end. Accounting mismatch. So I will revise again. Only in these following cases a financial liability is FVTPL. Derivative contract, financial guarantee or loan guarantee contract, contingent consideration, and accounting mismatch. So if it is not fitting into this four, then those financial liability will be treated as amortized cost. If it doesn't fit into this four, then other financial liability will be treated as amortized cost. So let us understand the accounting of financial liability. Very important, highly tested in the exam. Kindly pay attention. So yes, let us understand accounting. We have understood the definition part. Now let us come to the accounting measurement part. At the beginning, at the inception, financial liabilities should be measured at fair value. At the beginning, financial liability will be measured at fair value. Now what is fair value in the case of financial liability? Fair value means proceeds minus transaction cost. So for example, you have taken a loan of 10 lakh and 10,000 rupees was transaction cost, brokerage. So you will say the fair value is 9,90,000. Proceed minus transaction cost. Fair value is proceed minus transaction cost. Now next, some important points to be kept in mind. If financial liability is short term in nature, so usually your creditor, bills payable, short term borrowing which is below 1 year, then these are not discounted. These are not discounted. No discounting, no complicated accounting required. Simply the difference between the settlement amount and the book value will be transferred to P&L account at the time of settlement. But if the financial liability is long term in nature, that is the amount will be paid after 12 months, then it should be discounted. Fair value is considered at discounted value. Here, effective rate of interest should be calculated for accounting purpose. Effective rate of interest means IRR. IRR will be calculated. So you will calculate fair value in the beginning. You will see what are the cash flows you have to make over a period of time. Find out that discount rate. At which the present value of the future cash flow is equal to the fair value today, and that discount rate is called EIR or IRR, effective interest rate or internal rate of return. One more thing, if you are showing financial liability at amortized cost, it will not be subsequently remeasured. Financial liability at amortized cost is not subsequently remeasured. So to make your life easier, If the category is amortized cost category, if the category is amortized cost category, the entry at the inception will be bank account debit to financial liability account. Bank account debit to financial liability account, and the amount will be equal to proceed minus the transaction cost. At the end of the year or every interest payment date, you will create a liability borrowing cost account debit to financial liability account, and this is calculated using effective interest rate. This will be calculated using effective interest rate. So opening liability you will take multiplied by effective interest rate, that will give you the borrowing cost. This amount you will record. Highly tested in the exam. Sometimes they will say that company has recorded the interest based on actual payment. We don't record on the basis of actual payment. We will record by applying effective interest rate on the opening balance. Any payment made will be debited to financial liability account, to bank account, and if settled in case of paying in the form of equity instrument, then to equity, being amount paid. Some care we have to take. This borrowing cost will be transferred to P&L account. Borrowing cost will be transferred to profit and loss account. However, you have to also see Ind AS 23. Ind AS 23 borrowing cost. If they permit capitalization, then you can capitalize it. Second, in the balance sheet, the financial liability will be treated as a non-current liability or current liability. In balance sheet, financial liability will be non-current or current depending upon the due date of the payment. If the amount is payable within 12 months, that portion will be treated as current, and if the amount is payable beyond 12 months, that portion will be treated as non-current. Next is treatment of zero coupon bond or deep discount bond. These bonds do not pay the principal amount only. So these bonds do not pay interest amount, only the principal amount is paid on maturity. Still, they will be treated as financial liability because there is a contractual obligation to pay the principal amount. They would be treated as amortized cost instrument, and the company will follow effective interest rate for accounting of zero coupon bond. Another special situation is perpetual bond or non-redeemable bond. These bonds do not have a maturity date. Only coupon will be paid. Principal amount will not be repaid. So whether these are financial liability or not. So what we will do, we will check the financial liability by how much is the coupon paid periodically divided by the market rate of interest. This portion will be treated as financial liability. Remaining amount will be treated as equity. So perpetual bond can be just financial liability, or it can be a hybrid instrument which may contain equity also. So financial liability is the present value of the future interest payment. If there is a difference between the fair value and the present value of the future interest payment, then that portion will be treated as equity. Here split accounting is applied. Split accounting means we will have to find out how much is the financial liability, how much is the equity. So this is how perpetual bond will be solved. Now next question is whether preference share, very important because of the standard on financial instrument in India. Now there is a big change in the accounting of preference share. When you are in 11th standard, 12th standard, CPT, foundation, intermediate, you have shown preference share along with equity share in the balance sheet. But now the situation has changed. preference share can be a liability instrument. In that case, it will appear in the current or non-current liability section of the balance sheet, or it can be a equity instrument also, or it can be a compound instrument also, depending upon how that preference share is designed. Okay, so if preference share are redeemable, if the principal amount, the face value is redeemable, then that part of the preference share will be a financial liability, because there is a contractual obligation to pay cash. If preference shares are irredeemable, that means there is no contractual obligation to pay principal amount, then that part is treated as equity instrument. If preference shares are entitled to mandatory fixed dividend, underline mandatory fixed dividend, company has to pay, there is no choice, then mandatory fixed dividend payment, that part will be treated as financial liability. Some more example on preference share. You have to participate and answer. Preference shares are entitled to cumulative preference dividend, cumulative fixed dividend. I will give you 100 rupees if you give me correct answer. Preference share are entitled to cumulative fixed dividend, whether this entitlement to cumulative fixed dividend is a financial liability or equity, whether it is financial liability or equity, whether it is a financial liability or equity. Now the students are thinking it is a financial liability, but the answer is it is equity. Why? Because company may not pay, company can keep on deferring forever. Okay, company can keep on deferring it. That means there is no contractual or mandatory obligation to pay, it will just keep on accumulating, so it will be treated as equity. Next question, yes, please reply. Preference shares entitled to non-cumulative fixed dividend. Non-cumulative means it will not accumulate, so that will also be treated as equity instrument. Okay, question for you, this can be exam question, whether following preference shares are equity or liability. Third, preference shares are entitled to dividend linked with ordinary share. That is, if dividend is paid to ordinary share, then dividend will be paid to preference share also. Is it liability or equity? Is it liability or equity? The answer is equity, because dividend payment on equity share is not obligatory. You can indefinitely postpone the payment of dividend on equity share, and therefore you have indefinitely postponed the payment of preference share. Next question, preference shares are convertible into, underline, fixed number of share. If preference shares are convertible into a fixed number of share, that means fixed cash against fixed number of share, then that part is treated as equity instrument. If preference shares are convertible into variable number of equity share, so here fixed cash was received, but variable number of shares will be issued, so then that part is called financial liability. If preference share is redeemable and dividend is non-cumulative, so this part is liability and this part is equity. So an instrument which has both the features of equity and liability, such instrument is called compound financial instrument. Such instrument is called compound financial instrument. So if a preference share is redeemable and the dividend is non-cumulative, so there are two elements. One is the redemption of the principal amount, which cannot be avoided, so liability, but dividend can be avoided, so which is equity. Equity plus liability, it is called compound financial instrument. Another important question for exam purpose could be FCCB. FCCB means foreign currency convertible bond. So dear student, if you are watching this video, please like the video and most importantly subscribe to this YouTube channel AS Foundation. Please immediately subscribe and also share with your friend, because we are going to come out with more video lecture on FR short revision, where in almost 1 hour we will be able to revise one standard in a day. So now an important discussion is FCCB. It is a carve out. A carve out means a major difference between Ind AS and IFRS. So FCCBs are treated differently in our standard Ind AS 32 and IFRS standard number IAS 32. Now whenever a company issues bond, which is a foreign currency convertible bond, there is an equity conversion option or right. That means the holder will get a certain number of equity share. Holder will get a certain fixed number of own equity share, and these bonds were issued in foreign exchange. These bonds were issued in foreign exchange. So this will come under the definition of a non-derivative contract, element number 3 of financial liability as per Ind AS 32. It is a non-derivative contract which will be settled in fixed number of own equity share. A non-derivative contract which will be settled in fixed number of own equity share as per our Ind AS 32. If it is settled in fixed number of own equity share, then it is equity. But what the international standard 32 says, okay, you are issuing a fixed number of equity share, but the amount of cash is not fixed because the foreign exchange rate is changing. As the foreign exchange rate is changing, the consideration is not fixed. Number of shares are fixed, consideration is not fixed, and therefore we will call, that means IFRS will call it as a financial liability. The IFRS calls it as a financial liability. So this was about financial liability and equity. Now we'll deal with what is financial asset. Just for your information, Ind AS 32, the major focus is on financial liability and equity, and in Ind AS 109 the focus would be more on financial asset. But in the standard Ind AS 32, we'll just have a quick discussion about the definition of financial asset. Okay, a financial asset has following 6 elements: 1, 2, 3, 4, 5, 6. If any of the 6 elements are present, then we will call it as a financial asset. Cash by definition is a financial asset, because RBI has issued the currency note. So financial asset for you and liability of the RBI. Then equity instrument of another entity. If you are holding equity instrument, equity share, for you it is a financial asset, for the other party it is equity. Then contractual right, it should be a contractual right to receive cash or other financial asset. The student will remember this was element number 1 in financial liability, where it was written a contractual obligation to pay cash or other financial asset. So this is the way to remember, except the first and the second one. The remaining 4 are similar to the 4 elements you have studied in financial liability. Fourth point is, it is a contractual right to exchange financial asset or financial liability in potentially favorable condition. These are derivative. So for one party, a derivative would be a financial asset, and for the other party derivative would be a financial liability, because for one party when the derivative turns favorable, for the other party the derivative turns unfavorable. The next element, number 5, contract which will be settled in own share, which are non-derivative in nature, and the entity will obtain variable number of shares. Similar to element number 3 of financial liability, non-derivative contract which will be settled in variable number of own equity shares. And the last one is contract will be settled in own share that are derivative in nature and which will be settled in other than fixed cash for fixed number of shares. So these are exactly reverse. The last one is non-derivative contract which will be settled in variable number of equity share or variable cash, but not fixed cash against fixed number of shares. If any of these 6 elements are present, then that contract will be a financial asset and the entity will apply Ind AS 32 and Ind AS 109 for accounting, measurement, recognition, and Ind AS 107 for disclosure purpose. Now, what is the meaning of equity? What is the meaning of equity? We have seen financial liability, 4 elements are there. We have seen some special cases of financial liability. We have seen financial asset, there are 6 elements. More about financial asset in another standard. More about financial asset in another standard, Ind AS 109. Now next is the definition of equity. Okay. One student is asking example of point number 4 and 5. Point number 4 example is, suppose you are holding a future contract and you have long position, you have bought future and the price has gone up, then it is favorable for you. Okay. And contract which can be settled in own share are non-derivative in nature and will be obtained variable number of share. So for example, some loan is given to other party and it will be settled by giving back to you your own share, but the number of share will be issued will be based on market value of the share. So if I have given you a loan of 10,000 and you are going to return my share, but the number will be based on market price. So I am going to get variable number of shares. So that is a non-derivative contract settled in variable number of own share. Right? We'll come to definition of equity. Equity shareholder is the last person in the queue. Suppose this is the queue which starts from here. This is the last person in that queue, that is equity holder. A contract that evidences residual interest in the assets of the equity after deducting all the liabilities called equity. That means assets minus liabilities. First the asset will be used to pay all other liabilities and whatever is remaining is called equity. They have a residual interest. They are the last person to receive their amount. So now the question is, what are the financial instrument or components of financial instrument which will be treated as equity? One is ordinary share. Don't write equity share, write ordinary. Ordinary share means no preference of any kind. No preference of any kind, whether it is payment of dividend or redemption or anything, then it is called ordinary share. Ordinary shares are equity instrument. Then second is those instrument or component which pass fixed test. Those instrument or component which pass fixed test means fixed number of cash will be received against fixed number of equity shares. Fixed cash, fixed equity share is equity instrument. those instrument or component which passes fixed for fixed test. So this will be a non-derivative contract, and this will be a derivative contract. That means fixed cash and fixed number of equity share. And then there are deemed equity, which is given in para 16A to 16D. This I will discuss later. Deemed equity means they have the feature of financial liability and they have the feature of equity also. So the standard says you please call them deemed equity only, and they will be treated as equity instrument. So this we will discuss later. So if an instrument has feature of both financial liability and equity, if an instrument has feature of both financial liability as well as it qualifies for deemed equity, then the standard says it will be deemed as equity instrument. So like for example, we'll discuss after some time conditions for deemed equity. Putable instrument. What is a putable instrument? The investor can surrender the bond before maturity and can get cash. That is putable instrument. Or instrument which obligates to deliver pro rata share of net asset on liquidation. That means the holder of the instrument will get pro rata share in net asset, but at the time of liquidation. So he is getting cash also, but that cash is paid at the time of liquidation. Such instruments are treated as deemed equity. Second condition is such instruments are most subordinated instrument on liquidation. Most subordinated instrument on liquidation, that means they will be paid after all other liabilities have been paid. Such instruments are entitled to share in net asset only. So this instrument will get share in net asset and they should not have any limit. So whatever is the net asset, they will get a share in that, which can be very high, very low. Then such instruments should have identical features, and these instruments have no other right like right to convert or any other special redemption right. No special right attached to such instrument. Total cash outflow on such instrument should be based on profit and loss of the entity. Cash outflow on such instrument is based on profit and loss of the entity. And point number G, entity should not have another contract which is not at arm's length with such instrument holder. The last line probably is not appearing on the screen. That means there should not be any other contract with the same holder which is not at arm's length. So that means there should not be the benefit transferred in any other form. If these conditions are present, then the instrument will be treated as deemed equity and will be accounted as equity instrument, not as a debt instrument. Another question is set off of financial asset against financial liabilities. Can financial asset and financial liability be set off against each other for presentation purpose? The answer is yes, if two conditions are satisfied. Condition number one is there is a legally enforceable right to set them off, and condition number two is the entity intends to settle on the net basis. There must be legally enforceable right. The law of the land must allow net settlement. If you have an importer and exporter in foreign country, then the law does not allow you to settle on net basis. From importer you will get money, to exporter you have to pay money separately. But suppose this debtor and creditor is within the country, then you can do the set off, but at the same time the party must intend to settle on net basis, or even if not on net basis, assets and liabilities are settled simultaneously. That means at same point of time one party will receive and one party will pay. Okay. Now next is treasury shares, what we call buyback of own shares. In India we call it more popularly buyback of own share. but in foreign countries, when you buy back own share, they are called treasury shares. In some countries, they allow you to hold your own shares also. So the shares which are bought back are called treasury share. Whenever entity receives or buys back its own share, then what we will do, accounting treatment, we will cancel the equity. It is cancellation of equity. Reduce your equity. Profit or loss will not be recognized in P&L account. Profit and loss will not be recognized in P&L account. Rather, it will be adjusted in equity only. Consideration paid or received will be recognized directly in equity. Such treasury shares may be acquired and held by the entity or by the members of the consolidated group. Sometimes a group member may acquire share in another group, another member in the group. One group member may acquire share in another group member. Then at the time of consolidation, they will be cancelled. The investment in the equity share will be cancelled and the share capital will also be cancelled. So while preparing consolidated financial statement, consideration for treasury shares acquired and held by other members of consolidated group is deducted from equity. Institute has so far not asked question on treasury shares. What is the treatment of dividend, interest? If the dividend or interest is paid on financial liability, it is treated as expense. If the dividend or interest is received on financial asset, it will be treated as income in P&L account. If any transaction cost on equity will be incurred, like issue expense, then it will not be recognized in P&L account. It will be adjusted directly in equity. For example, share issue expenses. But if you incur transaction cost on equity and the equity instrument is not issued, then it will be written off in profit and loss account. One important thing, equity is never remeasured. Equity is never remeasured. Some examples of income and expense. Interest payment on bond is expense. Will go to P&L account. Dividend on preference share, which is classified as a financial liability, is an expense, P&L account. Gain and losses with redemption or refinancing an instrument classified as a financial liability is an expense which will go to P&L account. Gain and loss relating to carrying amount of an instrument which is a financial liability will be transferred to profit and loss account. So the summary is, if the instrument is classified as a financial liability, the corresponding interest, dividend, gain, loss will be transferred to profit and loss account. Okay. But if the instrument is classified as equity, then the dividend payment will be adjusted within equity. Then you will directly adjust in SOCIE. You will reduce from reserve in SOCIE. Similarly, if there is any incremental directly attributable cost incurred on issue of equity instrument, already discussed, like transaction fees, regulatory fees, they will be adjusted directly in equity. When I say directly adjusted in equity, it means it will be adjusted against reserve and surplus items like general reserve or retained earning in equity. One more important part is compound instrument. Okay, so you will not be able to see the heading, but I will explain now. We are going to discuss what is called compound instrument. Very, very important. Okay, very important. When you go to exam, read this part. I'll just tell you, this is the book called Financial Reporting Compact Book, unique book. You'll find only on our website vinod.in, and it covers your entire Ind AS in very simple language, very useful for CA student, CMA student, even those who have qualified the exam, they can refer this book, one-stop solution for Ind AS. So, accounting treatment of financial liability under amortized cost method. When we are given a question, we need to check step 1 whether it is a pure financial liability or it is a hybrid instrument. Now, how do we know whether it is a hybrid instrument? A hybrid instrument is also called compound financial instrument, and it will have two components. Component number 1, financial liability, and second component is equity. Financial liability component will be accounted as per the standard applicable for financial liability. Equity is not remeasured. If the instrument has an option to convert into share, if any problem contains an option to convert into share, then it means it is a hybrid instrument. Case 1. See what kind of question can be asked. If the principal amount is payable on maturity in cash and coupons are paid periodically, so there is only coupon payment and principal payment, but principal is paid in cash on maturity, then it is a pure financial liability. Then it is a pure financial liability. If coupons are paid periodically and principal is redeemed by issue of fixed number of equity share, as we have studied today, fixed number of equity share means equity component, then the interest portion is liability and the redemption portion, which is in fixed number of equity share, is equity. Therefore, a combination of liability and equity is a compound financial instrument. Case number 3. If coupons are paid periodically, this portion will be liability, and there is an option to redeem in cash or fixed number of share, and there is an option also to redeem in cash or fixed number of share. So if the holder decides to get cash, company has no option but to pay him cash, or there can be a fixed number of equity share to be issued, or the holder may demand a fixed number of equity share to be issued. Then such instrument is called CFI, compound financial instrument, because there is an option to issue fixed number of equity share. So when there is an option embedded in the instrument under which fixed number of equity share will be issued, that portion becomes a compound financial instrument. So what we have to do, because now it is a hybrid instrument, a compound instrument, I have to split the liability portion and the equity portion, because the accounting treatment of liability portion is different from the accounting treatment of equity portion. So we'll have to now identify how much is the liability component and how much is the equity component. To find out the liability component, I have to check what is the contractual obligation to pay cash. What is that amount of cash which we cannot avoid? Second, what is the contractual obligation to pay variable number of own share, variable. This portion is financial liability. And what is the contractual obligation which cannot be avoided? So this portion is financial liability component. Then identify the discount rate to be used in split accounting. because the cash flows will take place in future period, I need to find out the present value to find out the liability portion. So what I'll do, I will see what is the market rate for similar instrument. That rate will be used, which can be MIBOR, LIBOR or any such rate. The present value of the future cash flow is financial liability. Then what is equity? As you have studied, equity is the residual interest. So from the proceeds, but without transaction cost, very important, transaction cost I will tell you separately. I will not deduct transaction cost here, because if I deduct here, the entire transaction cost gets allocated only to the equity part, only one instrument, but transaction cost needs to be apportioned. So I will take only proceed without transaction cost minus financial liability we have computed in the step 4, and that is equity. So in the exam, two type of questions are asked. One is with transaction cost, one is without transaction cost. If it is without transaction cost, then it is very easy. We have got equity portion and liability portion. But if there is a transaction cost, if there is transaction cost for issue of this instrument, then it will be allocated to financial liability and equity. So what will be the ratio? For financial liability, this is the ratio. For equity, this is the ratio. So for example, this may be 9 lakh, this may be 1 lakh. So if there is any transaction cost, it will be allocated in the ratio of 9:1. So we will deduct the transaction cost from liability and equity. So my financial liability will become the amount calculated in the step 4, which was present value of future cash flow, minus transaction cost allocated. Now there will be a problem. What is the problem? The financial liability you have computed in step 4, that figure will change. That figure will change because you have deducted transaction cost. So what you will have to do? In such case, you will have to recalculate IRR. You have to recalculate IRR based on revised value of financial liability. So this is very, very important. Many times the student forget to recalculate IRR in case of compound instrument where you have transaction cost. So accounting treatment now, initial recognition, bank account debit, proceed less transaction cost because you will receive net amount, to financial liability as we have computed in step 7, and to equity, that means step 5 amount minus allocation of transaction cost. So this will be my initial entry. Equity will be reported in SOI. Equity will be reported as SOI, as in SOCIE as component of equity. What about subsequent accounting? If financial liability is amortized cost instrument, its fair value will not change. And as you know, equity is not fair valued again after initial recognition. Then as usual, we will record the borrowing cost account debit based on effective interest to bank account, the payment made, and to financial liability will adjust the balancing figure. Some students prefer to pass 2 entries. So you can pass 2 entries separately also. First entry you can pass borrowing cost to financial liability, that is calculated based on effective interest rate, and whatever payment you will make, you will pass the entry financial liability account debit to bank. Whatever borrowing cost you have incurred here, this figure will go to P&L account as an expense unless capitalized under Ind AS 23. Student make a mistake. The payment that they are making, that they transfer to P&L account. No, that was CA intermediate, that was foundation 12th standard. In final, you have become a bigger entity now. You are a more learned person now. Now see the presentation in the balance sheet. Non-current liability, financial liability, borrowing, that component of borrowing which is due after 12 months will come under non-current liability, and that portion which will be due within 12 months will be treated as current liabilities. Let us come to the settlement date. Let us come to the settlement date. Conversion into equity share. Suppose the instrument requires mandatory conversion into equity share. Fixed number of equity share have to be issued. Equity account debit which you had credited earlier, and from that equity account you credit share capital and credit securities premium. If variable number of shares have to be issued, that means the instrument was earlier treated as financial liability, because variable number of shares to be issued means the instrument is a financial liability. So financial liability account debit to share capital and excess amount to securities premium. That was mandatory conversion. Now optional conversion. Suppose we settle the financial liability by paying cash. Suppose the holder wants cash, financial liability to bank. Suppose the holder wants shares. Suppose the holder wants shares or we issue shares, then the liability account debit to share capital to securities premium, and whatever is the balance left in equity account, that we will transfer to securities premium account. Although the standard does not tell you which account you will credit to, but normally we will transfer to securities premium, or we can transfer to any other reserve also if there is any balance in equity account. Okay. If deferred tax is to be calculated, because Income Tax Act does not deal with compound instrument, they still follow the old method of accounting. So there will be a difference between the book value and the tax base. Book value and the tax base. So that will be covered by Ind AS 12. We will discuss separately. Any interest paid will be transferred to P&L account unless it can be capitalized. And how do you compute the interest here? Under amortized cost, take the opening balance of financial liability and multiplied by IRR. Now we'll discuss the last part of the standard. Early redemption of financial liability. Early redemption of financial liability. Early redemption of financial liability. So usually the company may ask the holder that we want to redeem the financial liability before the due date. Okay. Now the question is, if it is a compound instrument, where the company decided to redeem it before the due date, how much amount will be adjusted in P&L account and how much amount will be adjusted in equity? Let us see. So difference between carrying amount, suppose this is carrying amount of financial liability 1 lakh, and suppose the amount paid to settle is 1,15,000. The company says take 1,15,000 and let us close our liability. So what is the difference? The difference is 15,000. How that 15,000 will be treated? So first is difference in the carrying amount. This is my carrying amount of financial liability, and revised carrying amount based on balance cash flow and revised discount rate. So I will calculate the value of liability again by calculating present value of remaining cash flow using the discount rate which is available on the date of early redemption. I will recalculate the value of liability using the revised discount rate which is available on the date of redemption. Suppose this revised liability comes to 1,05,000. Based on revised discount rate, my liability comes to 1,05,000. So this difference of 5,000, what will I do? This difference of 5,000 is the gain or loss on remeasurement of liability, and it will be transferred to P&L account. It will be transferred to P&L account. But what about this difference, 1,05,000 and 1,15,000? Difference in the revised carrying amount means 1,05,000 on balance cash flow and revised discount rate versus the amount paid 1,15,000. Difference between the revised value of liability and the amount paid, it is called gain or loss on settlement, and it will be adjusted within equity. Sir, why it is adjusted within equity? If I adjust it within P&L account, it will amount to remeasuring equity, and remeasurement of equity is not allowed. Okay, that is why the difference between the revised carrying amount of liability and the amount paid will be treated as adjustment in equity. Whatever is the balance left in equity, now any balance left in equity account will be transferred to other component of equity. Balance left in equity account will be transferred to other component of equity. Next is accounting mismatch. Accounting mismatch means you have financial asset, you have financial liability. Suppose there is a company called Silicon Valley. There is a company called Silicon Valley. It has financial asset which are suppose based on floating rate, and it has financial liability where the interest rate is fixed. So there is an accounting mismatch. There is an accounting mismatch. There is an asset liability mismatch. There is an asset liability mismatch. If they follow amortized cost for this, if they follow amortized cost for financial liability, if they follow amortized cost for financial liability, then the fair value of the liability will never go to P&L account, but change in fair value of the asset will go to P&L account. So P&L account will fluctuate. What the standard says, to protect your P&L account, this financial liability, instead of classifying as amortized cost, you classify it as FVTPL, so that gain or loss on both the liability and the asset will hit the P&L account. Loss in one will be compensated by the gain in another. And in that case, a financial liability, in order to correct the accounting mismatch, can be classified as FVTPL. Suppose you are adopting Ind AS for the first time. Ind AS for the first time, Ind AS 101 is applicable, and the problem will arise in case of compound financial instrument, because under old accounting standard, there was no concept of compound financial instrument or split accounting. But under Ind AS, if there is a compound financial instrument, then you have to separate the liability portion and the equity portion. So what I'll do, first I'll find out what is the liability portion based on contractual cash flow. Whatever contractual cash flow is there, I will find out that. I will choose an appropriate discount rate on the date of transition. So contractual cash flow which is remaining versus the discount rate, and I will be able to find out what will be the liability component of that compound financial instrument. So I got the liability component of compound financial instrument, but that instrument already has some book value. So old liability will be cancelled. Old liability debit to new liability as per Ind AS 32 will be recorded, and if there is any difference between the two, then it will be adjusted in retained earning. So this is the treatment on the date of transition, that is when the entity applies Ind AS for the first time. What will you do with the compound financial instrument? So dear student, we have prepared one book called Compiler. What is Compiler? It contains question answer of all Ind AS taken from study material, RTP, MTP, past exam, and some other good reference books also. So in one place, chapter wise, you will get all questions asked by the institute. So this will help you in your preparation for your exam. This can be used by CA student also, CMA student also, and those who are preparing for IFRS exam, they can also use it. This is called Compiler. Then there is another very good book I have prepared, which is called Financial Reporting Class Note with Solution. This is one of the most amazing books that I have ever prepared. It contains question, answer and theory both in one book only. Compact will have only theory, Compiler will have only question, and this Class Note with Solution have theory plus question. The answers are presented in exactly the same way we have taken in the classroom. In fact, we have taken the notebook of a student and we got it converted into a book so that large number of students can benefit from this Class Note with Solution. One-stop solution for your FR requirement. You don't need to refer any other book. You don't need to buy any book. If you have taken video lecture and if you find it too lengthy, then this notes cover answers also. It has taken almost 2 years to prepare this very high quality notes, where we have also covered the answer as dictated in our classes. So we have Class Note with Solution, we have Compiler, we have Compact, FR Summary Chart. These books you can purchase from our website vino.in. Right now we are offering this book at 30% discount. You can also purchase from our office located at Prestige Point, first floor, Pune. Student of Pune can come and purchase from our office also. They can have a look at it. If you want some sample pages, you can ask our office staff and they will provide some sample pages also. So you can email us on email ID any information that you need. If you want to purchase any book, video lecture, we have video lecture of other faculties also at a highly discounted price. So email is asfoundation1@gmail.com. You can call us. Our number is 97669 21860, or you can call us at 9667 671155. This is our WhatsApp number also. So I would request you to join our WhatsApp group, join our Telegram channel, Instagram, YouTube channel, and we will try to provide you maximum help that we can. So with this, thank you very much for watching this video. Please share with your friend also. I hope you liked it. Thank you very much.